Welcome to the Wavy Tunnel Plus, the Elliott Wave Ultimate version of the original Wavy Tunnel methodology. In this version, we fine-tune the Wavy Tunnel trades and provide new and fresh examples to illustrate these trading setups. Once you learn these setups, we go one step further and add harmonic chart patterns to the Wavy Tunnel setups. Welcome to Module 4, Trade Management. Thank you for taking the time to learn about a system which is timeless, applied to all traded markets and every market cycle. We hope you are enjoying this Elliott Wave method of recognizing and identifying trades called the Wavy Tunnel. In Module 4 of the Elliott Wave portion of this course, you learned about a trade management approach called the Elliott Wave Trading Map. You learned to identify point 0 in order to divide 10 positions into trades taken at various points in the Elliott Wave cycle. In this module, we will introduce another trade management approach, perhaps more straightforward to the Wavy Tunnel. The Wavy Tunnel is one of the best Fibonacci and Elliott Wave-based trading strategies that I have ever seen in my 30 years of trading. In this module, please pay close attention to trade management using multiple time frame analysis. Here is the course outline. So far, we've completed modules 1, 2, and 3, and we are currently in Module 4, Trade Management, where we introduce the 3 profiteers, a wonderful way to capture profits without giving back any. And Module 5, Trading Live, where we show you live trading setups with the entries and exits. In Module 6, we will cover the Elliott Wave connection, where we show the wave counts along with the Wavy Tunnel setup so that you can see how easy it is to spot the patterns without labeling the waves. And Module 7, which is new, includes the bungee semaphores and more on divergence. An aside is that the trading room uses these indicators and tools to pinpoint trend and end-of-trend moves in conjunction with the Wavy Tunnel. Learn how to use these tools to complement the Wavy Tunnel setup. In Module 4, the learning objects that we will cover include trade management, multiple time frame analysis, entries and exits, the 3 profiteers, and the 1, 2, 3 setup. In this module, you will leave understanding the thinking and background behind trade management. Trade management is about establishing your position based on the amount of risk in the trade and learning how to take profits along the way by identifying the potential profit areas, the PPAs. In this module, you will also brush up on 1, 2, 3 patterns for better entry. Continue picturing yourself riding the waves and cashing in on profits using the Wavy Tunnel system for success. Let's begin by reviewing the market cycle with respect to trade management. In the 5-wave market cycle, point 0 is the start of the move, and wave 5 is the final advance to point T, the termination point. In currencies and stocks, wave 3 is usually the strongest move with the steepest slope. In commodities, very often wave 5 is the longest. Learning the 1, 2, 3 pattern will help us to confirm the end of the trend. The 1, 2, 3 pattern will help us to confirm the PW-FG combo, price to wave fill the gap combo. Then, in Module 7, we will add the bungee, which will add further confirmation to the end of the trend. Wavy Tunnel trades can be broken down into 2 types. 1, the trend following trades, of which there are 4 setups, the breakout setups, and 2, the end of trend at point 0 and point T. There are 2 setups, PWFG. Each trade setup has a defined potential profit area which we are going to target when taking a position. The PPAs are determined from the Elliott Wave cycle itself, helped along with the Wavy Tunnel setup. Some observations. Let's review some observations from Module 3 of the Wavy Tunnel. When the wave and the tunnel come together on the one-day chart, then a big move is about to happen. Look for a break for trend continuation or the start of a new trend. When the wave and the tunnel are separating, then the current wave is likely to be an impulse wave. Look for the breakout trades. When the wave and the tunnel are coming together, then the current wave is likely to be a corrective wave. If there is divergence in the awesome oscillator, it could be an end of trend trade. The closer the EMA 12, the filter, is to the tunnel, the more likely the break will be sustainable. Multiple time frame analysis will be introduced in this module to be able to see synergies between different time frames. For example, a wavy tunnel breakout on the 1-hour chart is consistent with a fill-the-gap trade on a 4-hour chart and a PW trade on the daily time frame. An example will follow shortly. The smaller time frame will give an earlier entry strategy. For example, a breakout trade on the 15 or the 5-minute chart precedes the breakout on the 1-hour chart. That is why we use breakouts on the smaller time frames for confirmations of the start of the move. Next point. A retracement to the tunnel on the 15-minute chart is the same as a retracement to the wave on the 1-hour chart. Final point. On the 15-minute chart, if the currency breaks the wave and the tunnel, then the target is usually the tunnel on the 1-hour chart. You will begin to internalize these relationships once you start working with the multiple time frames. Let's look at some examples now. Case study on the Euro-USD using the daily, the 4-hour, and the 1-hour charts. This is the daily chart. The PW trade is evident on this time frame. Let's review the trade setup conditions for the PW trade. Is price headed into space, away from the filter, the wave, and the tunnel? Yes. Is divergence present in the awesome oscillator after a 5-wave sequence has occurred? Yes. Here is wave 3, wave 5, divergence, price makes a new low, the awesome oscillator does not. Rubber band effect. Is the current price hyperextended from the wave? Yes. The conservative entry strategy is to enter the trade as it heads back towards the wave. Enter the trade with a reversal candlestick pattern such as a hammer, a shooting star, a morning star, and engulfing candles. Is there a reversal pattern on the chart? Yes, there is. This is called an engulfing pattern. So notice the PW trade on this daily chart, which is the fill the gap trade on the 4-hour chart, which is the... Let's keep the suspense going while we analyze the fill the gap trade. Let's review the trade setup conditions for the fill the gap trade. A bounce off or through the wave headed for a collision with the tunnel after the wave 2 or B ends. Divergence present in the awesome oscillator after a 5-wave sequence has occurred, either beginning a wave C or a wave 3. Zigzags work best. In this example, we have a zigzag with a flat B wave prior to the C wave. And finally, look for the current gap between the wave and the tunnel to be greater than 75 pips. That is in the currencies, but duly noted that in stocks and commodities, that gap will be different. Use common sense with regard to the gap, and if it is reasonable to establish a profit target based on the gap. The conservative entry point, enter the trade as it heads back through the wave when candles are exiting the filter. That would be right here. Look for a reversal candlestick pattern. Notice the PW trade on the daily chart, which is the fill the gap trade on this 4-hour chart, which is the breakout trade 1 on the 1-hour chart. When these three time frames line up like this, the setup is remarkable. This is the ideal setup for taking risk. Print these charts off and place them side by side so that you can duplicate these trades over and over again. Notice you can trade each setup on its own. You can trade the PW on the daily chart. You can trade the fill the gap on the 4-hour chart. You can trade the breakout 1 on the hourly chart. So why look at 3 time frames, you might ask? For confirmation. Traders need confidence in order to pull the trigger. This top-down approach provides that much-needed confidence. It also provides a confluence of profit targets. The profit targets are the same for each wavy tunnel trade. The daily PW profit target is the wave. The 4-hour fill the gap target is the tunnel. And the breakout 1 target is when price crosses back below the 12 EMA or the filter. I do hope you are starting to get as excited as I am about this. Multiple time frame analysis illustrates the synergies between different time frames. In the previous example, the PW on the daily is the equivalent to the fill the gap on the 4-hour, which is the breakout 1 on the 1-hour chart. The implication is, by taking a breakout 1 trade off the hourly, since it is the smallest time frame when compared to the 4-hour and the daily, of course, and therefore the entry should be better, you can find price targets by looking at the bigger time frames. The 4-hour tunnel for the fill the gap is the 1-hour breakout 1 trade target. The daily wave for the PW is also the 1-hour breakout 1 target. As a swing trader, look at the daily and the 4-hour to develop confidence in taking a trade off the 1-hour time frame. The risk and profit targets are more easily defined. In this case study of eBay, we look at a day trader's time frames, the 1-hour, the 15-minute, and 5-minute charts. Here is a 1-hour chart of eBay with the wavy tunnel setup. The PW trade is evident on this time frame. Let's review the trade setup conditions again for the PW trade. Is price headed into space away from the filter, wave, and tunnel? Yes. Is divergence present in the awesome oscillator after a 5-wave sequence has occurred? Yes. Rubber band effect. Is the current price hyperextended from the wave? Yes. Conservative entry point. Enter the trade as it heads back towards the wave. Enter with a reversal candlestick pattern such as hammer, shooting star, morning and evening stars, engulfing candles. Or enter when price closes through the filter. Notice the PW trade on the hourly chart, which is the fill the gap trade on the 15-minute chart, which is the Let's analyze the fill the gap trade first before we get ahead of ourselves. Let's review the trade setup conditions for the fill the gap trade. Bounce off or through the wave headed for a collision with the tunnel after a wave 2/B ends. Divergence present in the awesome oscillator after a 5-wave sequence has occurred, either beginning a wave C or wave 3. Check, check, and check. What is the conservative entry point? Enter the trade as it heads back through the wave when the candles are exiting the filter. Look for reversal candlestick pattern. Let's notice the PW trade on the hourly chart, which is the fill the gap trade on the 15-minute chart, which is the breakout trade 1 on the 5-minute chart. When these 3 time frames line up like this, the setup is remarkable. This is the ideal setup for taking risk. Print these charts off and place them side by side so that you can duplicate these trades over and over again for day trading. Notice you can trade each setup on its own. You can trade the PW on the hourly chart. You can trade the fill the gap on the 15-minute chart. You can trade the breakout 1 on the 5-minute chart. The reason why we look at 3 time frames is for confirmation. Traders need confidence in order to pull the trigger. This top-down approach provides that much-needed confidence. It also provides a confluence of profit targets. The profit targets are the same for each wavy tunnel trade. The hourly PW profit target is the wave. The 15-minute fill-the-gap target is the tunnel. And the breakout 1 target is when price crosses back above the 12 EMA filter after we see divergence. Multiple time frame analysis illustrates the synergies between different time frames. In this example, the PW on the 1 hour is the equivalent to the fill the gap on the 15-minute, which is the breakout 1 of the 5-minute chart. The implication is, by taking a breakout 1 trade off of the 5-minute chart, since it is the smallest time frame and therefore the entry should be better, you can find price targets by looking at the bigger time frame. The 15-minute tunnel, fill the gap, is the 5-minute breakout 1 trade target. The 1 hour PW, the wave, is also the 5-minute breakout 1 target. As a day trader, look at the 1 hour and the 15-minute to develop confidence in taking a trade off the 5-minute time frame. The risk and profit targets are more easily defined. Here is some wavy tunnel trading work follow-up on multiple time frame analysis. Multiple time frame analysis trading work for swing traders. Set up your charts on the daily, the 4-hour, and the 1-hour time frames. Look for breakout, PW, and fill-the-gap trades on the 1 hour and see how the setups relate to the bigger time frames. Multiple time frame analysis trading work for day traders. Set up your charts on the 1 hour, the 15-minute, and the 5-minute time frames. Look for breakout 1, PW, and fill-the-gap trades on the 5-minute and see how the setups relate to the bigger time frames. Learn how to set potential profit areas, PPAs, by looking at multiple time frames. For example, the PPA for the 1 hour breakout 1 trade could be the 4-hour tunnel. The PPA for the 5-minute breakout 1 trade could be the 15-minute tunnel. Coaching and accountability. These are some coaching recommendations so that you can be accountable. Keep a trading journal on an Excel spreadsheet. Create a spreadsheet for each month of the year so that you will have 12 spreadsheets per year. In each spreadsheet, label the worksheets by date, so you could have 20 worksheets if you trade every day of the month. Use a screen capture software such as Snagit to grab the 3 time frames and label the setups. Start with observing the setups and labeling them. Then move to a demo account. Take 10 trades in order to refine the trade plan before trading live. Continue with the screen captures. Review the trades daily, weekly, and monthly. Now we are going to switch gears to a new topic: entries and exits trading methodology. This is a checklist for any trading strategy you use. We are, of course, going to apply it to the wavy tunnel, and the checklist is as follows. First, you have to choose your trading strategy. Then you have to establish your entry strategy. Decide on the potential profit area, decide on your stop loss position, calculate your risk reward based on your stop loss, calculate your position size based on your account size, use trade management to establish add-on and exit points, enter your trade in your trading platform, your trade station, and manage your trade. Let's go into these in a little bit more detail. 1. Choose your trading strategy. Set up your charts with the necessary analysis tools. For the wavy tunnel, set up the wave, the tunnel, the filter, and the awesome oscillator on 3 different time frames. So if you're a swing trader, you're going to use the daily, the 4-hour, and the hourly, and take your trades off of the hourly. If you're a day trader, you're going to look at the hourly, the 15-minute, and the 5-minute, and take your trades off of the 5-minute. You can also set up the 15-minute, the 5-minute, and the 1-minute if you prefer to trade off of the 1-minute time frame. 2. Establish the entry strategy. In order to do that, you really need to understand which part of the market cycle we are in. Trend, sideways, or top or bottom as in the end of the trend. And when we are at the end of the trend, we are looking for a market reversal. We're looking for a new trend in the opposite direction. Look at the candlestick patterns for breakouts and retracements. Look at 1, 2, 3 entries at the end of the trend, and we're also going to show you how to use 1, 2, 3 entries during a trend. Chart pattern entries and other entry strategies. For the wavy tunnel, look for the breakout, the fill the gap, and the PW trades. Number 3, decide on the potential profit area, the PPA, by looking at the charts. Look to see where the next area of support and resistance is using pivot points, Fibonacci retracements or projections, manual barriers, previous swing highs and lows, and trend lines and channels. For the wavy tunnel, look at multiple time frames for your PPA, as we just learned how to do. Number 4, decide on your stop loss position. Determine your stop loss price depending on your chart analysis, such as support and resistance. For the wavy tunnel, use the price high or low or the wave to set your stop loss, as we learned all along with the trade plan. 5, calculate risk reward. Determine if the trade is worth taking based on your success rate. For swing traders, we typically look for a risk reward of greater than 2 to 1. For day traders, oftentimes the risk reward is 1 to 1, and that's okay. It's okay if the success rate is higher than 50%. So that's what we have to keep in mind. As a swing trader or a position taker, maybe our success rate is only 30%. Maybe it's 40%. In that case, the size of the win relative to the size of the loss needs to be bigger. You cannot have the same size win as stop loss if the success rate is only 30%. Number 6, calculate position size. Determine the size of the trade based on the size of the stop loss, the account size, and your money management rules. Are you going to risk 1% on the trade, 2% on the trade? And when I say that, I mean 1 or 2% of your account size. That would be the risk. 7, use trade management strategy to establish add-on and exit points. So each add-on should be treated as a separate trade with its separate stop loss and profit target. 8, enter your trade in the trade station. And don't forget to include your stop, loss levels, and profit targets. 9, manage the trade. Move the stops and place add-on trades according to the rules of your strategy. There are various trade management methods, and we are going to talk about 4 of them. The first is to get in and out all at once. The second is to get in all at once and take profits at various levels. The third is to get into the position at various levels and get out all at once. And the fourth is to get in and out at various levels. We are really going to focus in on the second method, getting in all at once and taking profits at various levels. The 3 profiteers works very well with this. Which strategy to choose is a function of your trading experience. As you can see, strategies 1 to 4 go from simple to more complex. Just a few words on strategy number 1, getting in and out all at once. This is a very simple strategy. It's perfect for new traders. You enter and exit the trade at a predetermined price. So you're taking your full position based on your money management and based on your account size, and you're getting in at once, and then you exit the trade. Trade management is necessary for moving stop losses to break even once in profit. That's really, really important to do. It's important to lock in our profits, at least lock in so that we're not losing on a trade. It's hard enough to have successful trades, so if we can move our stop to break even early on in the trade, we're ahead. That's a win-win, even if we only break even on the trade. So again, which strategy to choose is a function of experience. The Three Profiteers is a trading methodology that we devised to get in all at once and take profits at various levels. This trade management method is good for maintaining balance on the fear and greed continuum. In particular, it's perfect for perfectionists who want to capture every last pip in the move. Imagine, if you are a perfectionist, being very disappointed by taking your profits too soon and leaving profits on the table by getting out too early. That's frustrating. Imagine holding a position and watching it go into profit only to have it come back and watch the trade go against you for a loss. This Three Profiteers methodology avoids those two examples of not taking your profits when you have them and not letting your profits extend by taking your profits too soon. With the Three Profiteers, we take our position all at once and we break it into three different positions. So we're taking a third of our profits at a certain level, the next third at another level, and the third at the final profit objective, all the while moving our stops and initially moving it to break even so that we don't take a loss on the position. How do we do this? Example number 1. 1. Determine the potential profit area, the PPA. Example, assume the PPA is 100 pips. Let's say we're looking at the fill the gap on the 4-hour trade and the fill the gap is 100 pips. That's our profit target. That's what we start with, 100 pips. That's what we're looking for. We use the Fibonacci sequence and work backwards from the 100 pips and pick 3 profit targets. The third needs to end at the PPA or the closest Fibonacci sequence to 100 pips. So we work backwards from the 100 pip PPA with the Fibonacci sequence to determine our profit objectives, and we get 34, 55, and 89 pips for profit targets P1, P2, and P3. 89 is the Fibonacci sequence number closest to 100 pips. So we really work backwards from 89, and we go 89, 55, and 34. So that's the first thing that we do, to establish our 3 profit levels based on the PPA. The third step is to set the stop loss at the first profit target, which is 34 pips in this example, and move the stop to break even once the first profit target is met. So move the stop to P1 once P2 is met. The fourth step is to calculate the risk reward. The reward will be 89 plus 55 plus 34 divided by 3 equals 59 pips per trade. And the risk is 34 pips. So the risk reward is 59 over 34 equals 1.74. That's assuming, of course, that all 3 targets are met. If the first 2 targets are met, then the risk reward goes down. Example number 2. Let's assume that the potential profit area, the PPA, is 60 pips. We choose the Fibonacci sequence number that is immediately below the PPA as the third and final profit target. So that would be 55 pips. Then work backwards from the 55 pips along the Fibonacci sequence to determine the remaining profit targets of 34 and 21 pips. So profit target P1, P2, and P3 would be 21, 34, and 55 pips. Then we determine the stop loss of 21 pips and move the stop to break even once the first profit target is met. So once the 21 pip profit target is met, the stop is moved to break even. We move the stop to P1 once P2 is met. So once we capture 34 pips, P2, that's P2, the new stop is P1, which is 21 pips. And 5, we calculate the risk reward, and the reward is 55 plus 34 plus 21 divided by 3 equals 37 pips, and the risk is 21 pips. 37 divided by 21 equals 1.74. The 3 profiteers. How do we apply the 3 profiteers entry and exit strategy to the wavy tunnel system? We enter with 3 positions on the breakout, the fill the gap, or the PW trades. We determine the potential profit area. We set 3 profit targets using the Fibonacci sequence, and then we move stops when stacked profit levels are reached. For stock trading, you might say, well, how do we use the Fibonacci sequence for stock trading? What I like to suggest is to use the Fibonacci sequence but treat those as dollar values. So let's say the PPA for a stock is $6. Well, you would work backwards and you would put a decimal point. So you would use $5.50 as your third profit target, $3.4 as your second profit target, and $2.1 as your first profit target. That's just an example. So you can still use the Fibonacci sequence when trading stocks by just adding that decimal point for the dollars. This is an example of how a money management calculator works to determine position size based on account size and risk taken. We will work through an example on the next slide. Most money managers risk 1% of their capital on any one trade. Money managers have value at risk models they use to determine the overall risk of the portfolio. Rule of thumb is 1% per trade with a maximum of 10% risk on the portfolio. Backtest and trade your system. Trade your system on demo first and follow your system. When you learn what the win-loss ratio is and the average win per average loss of your trading system, you will develop confidence in your system and know how much to risk on any one trade. It's very important to know the stats for your trading. If you give 10 traders the same strategy, let's say 10 traders traded the wavy tunnel, each trader will probably get different results because not all traders trade the same way. That's why it's important for you to define your trade plan and pick your time frames that you're trading. All traders are different. Some traders are swing, some traders are day, some traders are momentum traders, long-term position takers. The win-loss ratio will be different for all traders. It's really not about the system per se, because you're not going to be able to catch every single trade that sets up. Maintain proper reward risk ratio, that's important. Start with a demo account or a paper trading account, and please try to approach your trading as a business and to review your trades on a daily, weekly, and monthly basis. Let's run through an example now on how to use the money management calculator. Let's assume that the currency pair is the Euro USD, trade number 1. The trading account balance is $5,000. The maximum risk tolerance of this trader is 2% of capital per trade with a maximum risk of 6%. The stop loss of this particular trade is 25 pips. So then we take 2% times the capital of $5,000 and we get $100 at risk. Our potential profit is 50 pips. So the reward risk ratio is 2 to 1. 50 pips over 25 pips is 2 to 1. The pip per lot value is $10 per $100,000 lot size, or it's $1 per $10,000 lot size. That's how it works on the currency trading platforms that many of you are familiar with. Based on the stop loss and the amount of money at risk, $100, we cannot take a standard lot. If we multiply $10 times 25 pips, that would mean losing $250 when our defined risk tolerance is 2% of capital, which is $100. So we would be over our risk tolerance by $150 on that trade. By using a $1 per pip trade, a $10,000 lot size, we can figure out how many $10,000 lots we can take given our risk tolerance of 2% and the stop loss of 25 pips, which translates into $100 at risk. We figured out that we can take 4 mini lots or $40,000 traded. Some traders have even smaller accounts, $1,000 accounts, where the lot size is $1,000, 10 cents a pip. And this is called a super mini account, and the number of lots that can be traded is 40 super minis. Bottom line is the maximum position size for this account is 4 mini lots based on a 25 pip stop loss, which is a maximum loss of $100 or 2% of capital, should the trade go wrong. For currencies and CFDs, this formula is the same because it's all based on the currency trading platform. For stocks, the value of a dollar move depends on the position size traded. For futures, the value of a move depends upon the point value for that commodity and the number of contracts traded. So make sure you understand these calculations for any market traded. You will then be able to use the Fibonacci sequence and the 3 profiteers for your market traded, whether currencies, CFDs, commodities, or stocks. The 1, 2, 3 reversal is another trade management approach. 1, 2, 3 tops and bottoms are very powerful reversal patterns. They signal a trend reversal. Please do not confuse the 1, 2, 3 pattern with Elliott waves 1, 2, and 3. They are different. Let's explain. In an uptrend, the market hits a new high. We label that point 1 for the 1, 2, 3 pattern. Then the market pulls back to a short-term support level. We label that point 2. And resumes an upward move to a high that is below the point 1 high, called point 3. It then reverses again. The trade entry is as follows. The pattern is complete when the price trades below point 2. At a 1, 2, 3 top, the strategy is to sell on a break of point 2. The measuring objective is the distance between point 2 and point 3 projected below the breakout point. The stop loss is set just above point 3. At a 1, 2, 3 bottom, the market hits a low at point 1, trades up to point 2, trades back down to point 3, and back up through point 2, where you buy. Some observations. I like to see point 3 retrace at least 50% of the move down from point 1 to point 2. Let's look at some examples. This is an example of a 1, 2, 3 reversal and 1, 2, 3 bottom. Here price makes a new low. We label that point 1. The market moves up, stops, and comes back. We label that point 2. Where it comes back to is point 3. We like point 3 to travel the 50% distance between points 1 and 2. That would be ideal. Notice the equality trade from this setup as well. If price travels the distance from point 1 to point 2 and then retraces back to point 3, and we're expecting the same move in magnitude as the distance traveled between points 1 and 2 from point 3, that's the profit objective that we're looking for. And if 3 retraces 50% of this move, then 50% of this distance is really the profit target, the conservative profit target. So the 1, 2, 3 kicks off the equality trade. The 1, 2, 3 kicks off the end of trend trade. It's a very good reversal pattern. And once price moves back over the point 2 high, that's when you buy the market. That's the essence of the 1, 2, 3 reversal. So what is the trade entry? The market moves up through point 2 where the buy trade is triggered, and the measuring objective is the distance between points 2 and 3 projected above the break from point 2 on up. A note, which is very worthwhile, is that this is a breakout trade. So the wave comes parallel to the tunnel, breakout 2 trade. Use the PPA, the potential profit area of the 4-hour and the daily charts to determine the target. See what's going on in those charts to determine the target, and then use the 3 profiteers to take profits. So that's a good way to get you into this trend trade, and then use the bigger time frames for your profit taking targets. On the hourly chart, we're going to take the trade at 121 and a quarter on this 1, 2, 3 pattern, and now we're going to look at the daily chart on the next slide to determine the PPA. Here's the daily chart. Using the PPA of this daily chart to determine the target for the breakout 2 trade on the hourly from the previous slide, we determine that the PPA is the tunnel on this daily chart. We use the 3 profiteers to take our profits. Since the PPA is between 150 to 175 pips, we start at the Fibonacci sequence 144 and work backwards to 89 and 55 pips. We enter at 121 and a quarter, and we add 55, 89, and 144 pips to get our profit targets based on the daily tunnel. Here we see a 4-hour chart of light crude and a 15-minute chart of light crude. On the 15-minute chart, a breakout 1 is setting up. So there's a breakout 1 entry at approximately 108. We then look at a higher time frame, in this case the 4-hour chart, and we see that the equivalent of the breakout 1 is actually a fill the gap trade on the 4 hours. So we look at the tunnel to determine what the fill the gap potential price area is, where it takes us, and it takes us to approximately 104. The difference between where the trade is taken and where the profit level is $4. Then we take the Fibonacci sequence and we work backwards from 377, and we get 3 different profit levels: 377, 233, and 144. Our first profit target would be $1.44, followed by 233, and ending at 377, which would be at the tunnel. That's how, by using multiple time frame analysis, we can determine our potential profit areas when taking a breakout 1 trade on a smaller time frame. That's just another way to find targets. In addition to using multiple time frame analysis to determine the PPA for the breakout 1 trade, in this example, we have a 1, 2, 3 pattern setting up on the 4-hour chart. This 1, 2, 3 pattern is the equivalent of a PW setup to trigger the fill the gap trade. The point 3 is actually the wave 2 or B retracement before the wave 3 or C move. It's so comforting to know that there are many ways to look at the market to get the same analysis and results. Taking the 1, 2, 3 pattern on its own, we would sell the market for the fill the gap trade once we break down through point 2. The way we've learned to take the trade is to wait for price to break down through the filter for the fill the gap trade. So it is a slightly earlier entry point. Here's an example of the PW, and here is the setup for the FG. And notice how we have the 1, 2, 3 patterns setting up for the PW trade as well as for the fill the gap trade. Again, another way to skin the cat. If we label this point 1, the high of the market, and this is the breakdown point for point 2, and this would be point 3, once the market breaks down through this blue horizontal dotted line, that's the trigger for the 1, 2, 3 pattern, and that's also the PW trade. Then the market does a fill the gap and then retraces and does another fill the gap. On the retracement, which would be the wave B or wave 2, we also have a 1, 2, 3 pattern setting up, and we would sell through the point 2 which would take us down for our fill the gap trade. So 1, 2, 3 patterns really show up everywhere at market top and bottoms. This is a market bottom with the 1, 2, 3. And what a 1, 2, 3 pattern is as follows. It's a change in trend. So we make a new low. This we label point 1. The market reverses and moves up. Then it comes down. It retraces. But it doesn't take out the previous low. It retraces and then it continues on up. So we have a higher high and a higher low. That is how we define a trend change, a new trend in the opposite direction, kicked off by the 1, 2, 3 reversal pattern. Here's another example on how to use 1, 2, 3 reversals with PWFG trade. This is the British pound on the hourly chart. We look at the first example up here and we've labeled the 1, 2, 3 setup in red. The high price 0.1, price moves down, that's 0.2, price moves back up again, that's 0.3, doesn't make a new high, and then price breaks down through the blue horizontal line, and that's the start of the move down, and that's actually the fill the gap trade here. Down below, once the 5-wave sequence ends with divergence, and we see the nice divergence here, we have a 1, 2, 3 pattern setting up as well. We have 0.1, 0.2, 0.3. Once price takes out the blue horizontal line, it's up and away for another fill the gap trade. I want to also point out internal 1, 2, 3s. We see two examples that we've labeled right here, but there are more on this chart. The 1, 2, 3 labeled in black with the blue horizontal line. Those are internal 1, 2, 3s, whereas the first two examples are 1, 2, 3 reversals. The internal 1, 2, 3s get you into trend. It's trend continuation. So we label the high price 0.1, then price drops, that's 0.2, price retraces, that's 0.3, and we just run a horizontal line across 0.2, and once price takes out the 0.2, we sell. Moving to the buy side, here we label 0.1 as the start of the move. Price moves up, that's your 0.2. Price comes down, retraces, but doesn't make a new low below your 0.1. We call that 0.3. And then as soon as price takes out this 0.2, the blue horizontal line, you buy. So again, this is how to use the 1, 2, 3 to get into trend. The way we taught the breakout 3 trades, we're getting in on the pullback. So we would be getting in on the 0.3 as the 0.3 comes down and approaches the filter in this case. On the opposite side, the 0.3 moves up and retraces to the filter. We're thinking of the 0.3 retracements or the breakout 3 trades as the rubber band effect. Price makes a new low in a downtrend and then comes back to equilibrium as the rubber band snaps back to the moving averages, to the 12 EMA filter or the wave. It's two different ways to get your head around getting into trend. Either you're going to get in on the pullback in the case of a breakout 3 trade, or you're going to get in on a breakdown in the case of an internal 1, 2, 3. This is a nice illustration by Thomas of the 1, 2, 3 pattern. At the bottom of the market, 0.0, we label the price low as a 0.1, price moves up, that's 0.2, price corrects, and in this case it corrects 50%, that's 0.3. Price moves up and we take the trade once price breaks above 0.2. You might think that that's giving up a lot of pips in the case of currency pair by getting in when we break through 0.2. And that's where we can go down to a smaller time frame and take the same 1, 2, 3 setup on a smaller scale, because the markets are fractal, the markets repeat themselves over and over again, the patterns repeat themselves over and over again. So you can go down to a smaller time frame and take the same 1, 2, 3 reversal pattern if you choose to get in earlier. If we count the waves, we count waves 1, 2, 3, 4, 5. Again, don't confuse counting waves with the 1, 2, 3 pattern. But once we count 5 waves up, we can then take a look at the 1, 2, 3 reversal moving down. So the 1, 2, 3 sell. Price moves down, we label that point 2. Price moves up, we label that point 3. Point 3 cannot make a new high above point 1, and we enter the sell on a break of 2. If we would like to get in at a better price, we just need to go down to a smaller time frame and find that 1, 2, 3 sell. We can also look for the 1, 2, 3 sell right here from the point 3. So there are many ways that we can get into the market using the 1, 2, 3 pattern, either as a reversal pattern or as an internal pattern, as price breaks down and makes new lows every time as it follows the trend. This works very well. The 1, 2, 3 reversal works very well when an Elliott wave is extended. When we have an extended wave 3, for example, we can constantly get in on those breakout 3 patterns as price retraces to the filter or the wave, or we can use the internal 1, 2, 3s. In Module 7, we are going to show you another way to capture that breakout 3 trade by using the bungee, and also the end of trend trades by using the bungee. It's all about our mindset and how we see the markets. And both of these strategies have us seeing the market in a slightly different way. The 1, 2, 3 reversal is a breakout or breakdown pattern, so we're selling with the market momentum. The breakout 3 is selling on a market pullback, so we're actually selling on strength. The psychology is different to sell on strength when the market is moving against you than it is to sell on a breakdown with the market momentum. We need to practice to sell on strength, but once we do it enough times, it becomes second nature to us. It's easier for traders when they're first starting out, especially, to sell when the market is moving down, not to sell when it's correcting back up. But we learn all about Fibonacci, and we learn about the breakout 3 patterns. We have the bungee to help us, and that gives us confidence to sell on market strength. That's actually what we're doing when the market moves up. We want to be selling. This concludes Module 4, where we introduce trade management, multiple time frame analysis, and entry and exit methodologies, including the 1, 2, 3. We showed how you can determine potential profit areas, PPAs, based on wavy tunnel trades on higher time frames, and use the 3 profiteers to scale out of positions. And that means taking the position all at once and setting 3 different profit targets and moving the stop to break even initially and then to the next profit target when the second profit target is hit. We also learned an entry methodology called the 1, 2, 3 and illustrated this with the wavy tunnel trades and compared the internal 1, 2, 3 trend following setup with the breakout 3 trades. Module 5 will provide real trades and a discussion about fine-tuning entries and exits and weeding out the low probability trades with a candlestick primer. Thank you, and see you in Module 5.